David, can you comment on the market's volatility? Because it really has declined since Liberation Day.
Yeah, going into this year, we were expecting some heightened volatility. We certainly saw that in the first half of the year. 2024 was very historically low. We hadn't seen vol that low since 2017. And it really has declined nicely since then. But I do think we will probably see a pickup in volatility as the year progresses.
Are we going to see a pickup in inflation? Because we have seen a glimmering of inflation returning, and it's scaring a lot of folks.
Yeah, in the first part of the year, the vol we saw was record high vol, not only on the equity side, but in rate volatility. And I wouldn't be surprised if we saw an uptick in rate volatility to go along with the equity volatility in the second half of the year.
And your thoughts on the job market? We're trying to put a big picture together as to whether or not we're going to see stagflation. So first, the job market in your view.
It's weakened, and we saw those revisions in the most recent jobs report. But we've also seen a decline in immigration. So we're in this odd situation where the unemployment rate might not tick up, but we probably see weaker jobs numbers going forward.
Okay, so we have a little bit of inflation, we have the potential for weaker jobs numbers, and that I think is going to translate into a rate cut. Your thoughts on what the Fed's going to do going forward?
The Fed's going to cut on September 17th. I think we will see two, I think, this year, and the market's starting to lean toward maybe even 3 cuts. I actually think that's the right thing to do, and I think Chair Powell last Friday indicated he probably had a little more concern about the labor market than he does inflation in this environment.
Okay, so what are your thoughts on the economy, and what are your thoughts on the economy relative to what we're seeing in the equity market?
I think the economy is still fairly solid. The consumer is in good shape. Real wages are strong. Consumer spending has been solid overall. The soft data, consumer sentiment is very weak, but consumers are actually still out there spending, and that's the vast majority of the economy. So I don't think we're headed into a recession right now.
Okay, and what are your thoughts on the current levels of the 10-year and the 30-year Treasury? We've seen the 30-year really hanging around that 5% mark, and the 10-year really hanging around that 4.25% mark. Where are they headed?
We've seen some steepening in the curve, and I wouldn't be surprised if we see a little more steepening. We have rate cuts priced in at the front end, but there are long-term concerns about the federal deficit and debt, which would put pressure on the long end of the curve and steepen the curve.
Okay, so what are your thoughts? Once again, we'll break it up on the equity market going forward. So if you're going to be an equity investor, where do you want to put your money? In the S&P, maybe shift over to small caps because they've been rising a bit recently, maybe international. What would you do in terms of equities?
So we're overweight domestic, underweight international. Right now, our overweight to domestic is in large and mid. But you mentioned small caps. I think they're particularly interesting right now. Historically, you wanted to be in small caps as the economy comes out of a recession and really starts to accelerate. I think there's a world in which small caps do fine if we avoid recession and we see rate cuts. Small cap companies are far more levered than they used to be.
And then finally, what about on the fixed income side? Where do you want to be when it comes to bonds?
Yeah, we're about neutral duration. We're maybe a little long duration at the front end, expecting additional rate cuts. Credit spreads are pretty tight right now, so I certainly wouldn't take a lot of risk in the high yield space. But in absolute levels, investment grade bonds look pretty attractive right now.
All right, well, thanks for coming on and talking about it.
Thank you. I really enjoyed it.